Hello, very good morning to all. I'm Kelvin here again. Welcome back to today's Daily Dose of Market Insights. Today will be Wednesday. Very good morning to all, the 23rd of July 2025. So as usual, before we jump into the gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any recommendation any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so give me a couple of minutes just to make sure that, couple of seconds, just to make sure that everything is good over here. All right, so let's get started. Okay, so before the usual gist of the daily dose, which I covered the intraday technical outlook of the four major US dollar pair, the 6 major US stock indices, and the 2 key commodities asset class, which is i.e. gold XAU/USD, West Texas crude oil. As usual, we have a quick recap what has taken shape so far in terms of the intraday movement on all these broad-based cross asset classes, and how this intraday movement is being influenced by their respective key economic data or key economic news flow. All right, so let us start with the intraday performance of the major US stock indices first yesterday. So we know that at this juncture, we are actually in the heat of US quarterly earnings reporting season over here. So what we could see over here is that yesterday's movement on the major US stock indices was rather positive, I would say. All right, so how do I say that? If you look at the start of the S&P 500, there was actually a slight dip, and this slight dip only lasted for about half an hour. So by the time it hit the so-called the 10 p.m. Singapore mark, the S&P 500 continues to actually rally and close near the session high over here. So it actually managed to actually stay above the 6,300 psychological level. And if we still recall, both the S&P 500 and the Nasdaq 100 has already reached fresh all-time high early last week. All right, so the S&P 500 managed to actually inch out a small little gain of positive 0.06%. So even though the Nasdaq 100 underperformed yesterday, which is down by negative 0.5%, but the intraday movement of the Nasdaq 100 is also rather bullish as well, as price action managed to reverse up from its intraday low of that was being seen at the around the 23,000 handle level. To be precise, it's at 23. Give me a minute. Let's see, put the cursor on my mouse. 23,960. So at the 10 p.m. Mark Singapore time yesterday, the Nasdaq 100 managed to recover, but it did manage to actually close in the green, but it's still kind of down negative 0.5%. And the culprit of the Nasdaq 100 underperformance is actually due to more like a rotation play, where previously we start to see high flying semiconductor stocks, or the semiconductor we call it industry within the industrial sector, underperformed yesterday greatly. So this is the S&P 500 heat map. So very clearly there are actually more greens than red. So the reason why Nasdaq 100 underperformed against the S&P, because the technology stocks, especially those semiconductor stocks, has a very significant high weightage in the Nasdaq 100, especially Nvidia. So Nvidia now is the #1 market cap stock in the Nasdaq 100. So Nvidia is down by negative 2.54%. And the reason why Nvidia is down yesterday is actually impending a particular key player in the US semiconductor industry, which is Texas Instrument. So Texas Instrument reported its Q2 earnings yesterday, but the report came in after the US session closed. That means, i.e., today's is actually came in today's Singapore time after 4 a.m. So what's interesting over here is the market seems to anticipate a rather weak earnings guidance coming out from Texas, okay, prior to the after the close of yesterday US session. So Texas managed to right after US session close, it managed to inch up a small gain of positive 0.16%. But however, after 4 a.m., which is the close of the US session yesterday, Tuesday US session, the stock plummeted by 11%. All right, so there seems to be a bit of front running taking shape in the yesterday's intraday movement of the Nasdaq 100, where we start to see earlier underperformance before the earnings release of the Texas Instrument. So the causes was actually a sell-off in the semiconductor stocks, and indeed the market turned out as expected. The market actually anticipated correctly that this Texas Instrument earnings guidance is not rosy as what market is expecting over here. So let me share with you what happened over here. So this is the plunge of Texas Instrument. This is the intraday chart. So but this is the after the close of the US market. All right, so it plummeted all the way down negative 11% over here. So yes, the earnings managed to beat expectation, but the forecast of the Q3 revenue and the Q3 earnings did not sit well with analysts or investors and resulted in Texas Instruments stock diving 11% after the release of this earnings report after 4 a.m. Singapore time. All right, so the companies that you expect to earn between 1.36 and 1.6 per dollar per share for Q3. But however, analysts were predicting $1.5, that's the EPS per share. All right, so ISO forecasts revenue to come in between 4.45 billion and 4.8 billion in Q3, but analysts is expecting a higher amount of 4.59 billion. So that actually explains that dramatic sell-off over here. So, but however, we do have a pretty interesting consolidation during the early Asia session that managed to cushion this dramatic Texas Instrument negative sentiment from its after hours share price plunge of 11%. And if you look at the E-mini futures and the Nasdaq 100, both the S&P E-mini futures and the Nasdaq 100 E-mini futures, both of them didn't actually plummet in the red. All right, so the E-mini futures is actually up by 0.22% for the S&P, and the E-mini futures for the Nasdaq 100 is actually up by 0.09%. All right. Okay, let me share with you the price movement. Okay, so this is the E-mini futures. Okay, it rallied up at the start of the Asia session at 6 a.m. The Nasdaq 100 E-mini futures, not as quick as the S&P, still taking a bit of what I call negative feedback loop from that 11% dive of that Texas Instrument, which is considered as a key semiconductor player within the US semiconductor industry. But however, it didn't actually plummet deeply in the red, all thanks to trade deal optimism coming out from US. Why do I say that? Number one, Trump himself has really mentioned in his social media post, stating that Japan deal has really been more or less done deal, a confirmed, a locked in, and it was set at 15% instead of the earlier higher threat of 25%. And also closer to Southeast Asia, Trump also more or less has really concluded a trade deal with Philippines at 19% from the earlier what I call it earlier we call it higher tariff of 20%. And also with its negotiation with its key trading partners, China, U.S. Treasury Secretary Bissett. So Bissett now is going to be likely a point person or key U.S. Officials that he will be in charge of negotiation with Chinese counterparts. So yesterday, U.S. Treasury Secretary Bissett also mentioned that at this point in time, the current trade deals between US and China expires on the 12th of August, which is 2 weeks from now, and he likely will work out for an extension during the Stockholm talks. So actually, there will be a third round of trade talks in Stockholm coming up pretty soon. And he also did mention that trade is in a very good place with China. So with these three pieces of trade optimism coming out from the US, that managed to actually cushion the negative feedback loop of the 11% dive in Texas Instruments share price after the US session closed yesterday, and also explain why the Nasdaq 100 E-mini futures and the S&P E-mini futures are still in the green right now. And of course, with that so-called trade deal that is being done with the done in Japan, the Nikkei 225 continues to rally. And those who followed my so-called trade, those who followed my daily dose on a daily basis, last week we also do mention that the Nikkei 225 or the Japan 225 in our CFD platform has already shown signs of bullish momentum, and we flipped to a intraday bullish bias for almost all the day since 2 weeks ago, anticipating this turnaround, given there is actually a technical, we call it a bullish element that's being flashed out in the Nikkei 225. And Nikkei 225 rallied as expected and hit our short-term resistance right early today's Asia session. So where were the Nikkei 225 or the Japan 225 hit next? So later I will cover in my second segment of the intraday technical outlook for the Japan 225, and also that that so-called possible extension of this US-China trade deals to beyond 12th of August, and that optimism that is being expressed by US key point man between China and US trade deal negotiation, which is the US Secretary Bissett himself. That also lead to a positive feedback loop in the Hang Seng indices, where prices move also according to our expectation as portrayed in my intraday technical outlook on the Hong Kong 33. So the Hang Seng index, which represent the Hong Kong 33 in our platform, is up by 0.74%. The higher beta Hang Seng Tech index, which comprises the China big tech stocks, is up by 1.2%. And the HSCEI in full with the Hang Seng China Enterprise Index, which represent the key Chinese H shares listed in the Hong Kong Stock Exchange, is up by 0.9%. And the rest of Asia, we also see much positive vibes as well, where the Kospi 200, the South Korea Kospi 200 is almost unchanged, 0.04%. The TAIEX, which is the Taiwan stock market benchmark index, is up by 0.9%, and our STI continues to march up higher, positive 0.28% at 4,220. And even the Australia ASX 200 right now is up by 0.5%. All right, and now with that trade deal optimism coming into play, we also start to see the dollar, we call it, continues to sell off as well. So like I do mention over here is that if you look at the US dollar index, we're still expecting the US dollar index to actually involve in this medium-term downtrend phase since the start of this year over here. And we start to see very nice bearish reaction of the 50-day moving average that has taken shape on last Thursday, and it continues to plummet for 2 consecutive sessions. So on Monday, there was a bearish reaction, negative 0.62%, and also on Friday, on yesterday, it actually closes down below the 20-day moving average over here by this black Marubozu candlestick, which is down by negative 0.46%. So we continue to see this dollar weakness playing out. That means indicating that that rebound. Give me a minute. This rebound here from 1st of July low, we start of this month, all the way up to the high of last Thursday. So this is a minor corrective rebound. So this minor corrective rebound more likely has already ended, given that price action now has closed below the 20-day moving average, resuming its impulsive down move sequence for the US dollar index within its medium-term downtrend. That means, i.e., now the technical element now skewed more towards the bears for the US dollar rather than the bull. So whatever rebound that we see in the US dollar now is only a very, very minor intraday bounce, whereas the bigger picture now supports a dollar bearish movement, as being shared with you guys on the US dollar index just a few seconds ago. All right. So now, if you look at the movement on the broad-based 5-day rolling performance of the dollar against the other major currency. So what I did over here is that I use dollar as a base currency now. Means $1 equals to how many sterling pound. So what you could see over here is that the 5-day rolling performance as of now we are speaking is pointing also say a further dollar weakness as well. So the dollar is now the weakest based on the 5-day rolling performance basis against the Kiwi, which is down by 1%, against the Swiss franc down by negative 0.9%, and also against the euro dollar down by 0.8%. Also, previously the dollar yen was very strong, and the dollar yen strength has really reversed. Now it's down by negative 0.65%. So later I'll share with you what is the movement of the dollar yen when I cover the second segment of the second segment of today's we call it daily dose. And also, if you put it from a intermarket perspective, where I get the US dollar, not the US dollar, the US Treasury 2-year minus off the 2-year government spread is a weighted average between the key major currency: Germany, UK, Japan, Canada, Swiss, Australia, and China. The US Treasury 2-year spread premium has also started to reduce as well over here since last Tuesday. We look at it, it's sloping downwards. So what we could see over here is that from a intermarket dynamics, the factor, the yield spread premium between the US Treasury 2-year versus this weighted average of these major economies is also supporting further US dollar weakness. And if you look at the 1-day rolling performance basis, that means very intraday, yes, we see a spike up earlier on in the dollar yen. So the dollar yen at the start of today's early Asia session at around 10 a.m., there's a spike up. So after this spike up, it dwindled downwards. All right, so what causes this spike up in the dollar yen is actually these dovish remarks being made by Bank of Japan Deputy Governor Uchida. So Uchida mentioned that he kind of signaled in a public speeches saying that BOJ is in no rush to hike rate after the trade deal that's been announced by Trump himself in his social media post. So that causes a bit of blip up on the dollar yen, but however this blip up can't sustain, and the dollar yen starts to actually dwindle downwards in line with the broad-based dollar weakness that is being seen across the board over here. All right, so so this is the news flow that I want to share with you guys. And one more news flow I share with you is coming up from Monday, because yesterday I was away and there's no daily dose. So let me have a recap about this news flow out on Monday. It's more pertaining to this Tier 1 US economic data, which is the Conference Board Leading Index. All right, so this Conference Board Leading Index is a composite index where Conference Board itself try to compile it together to form a leading economic index. So that also comprises of stock market movement as well. So based on what market is expecting a further decline to negative 0.2% month on month, but it came down worse than expected at negative 0.3%. So if you go to the Conference Board website over here, just Google Conference Board, you're able to read in detail this leading economic index. And also, if you dive deeper, they will share with you how they compile this leading economic index by looking at much more economic data that tends to be more survey based and also sentiment based, which is the stock market itself. So the US LED fell further in June, and for the second month in a row, the stock price rally was the main support of the LEI, which is the leading index. But that was not enough to offset the still very low consumer expectation, big news orders in manufacturing, and the third consecutive month of rising initial claims for unemployment insurance. So all these are leading economic index where Conference Board compiled together to form their LED, the leading economic index. So if you look at it, this LED over here, the one in light blue, which is the leading economic index, continues to actually slide downwards over here. This kind of dramatic slide, right, in the past actually precede recessionary period in the US, which is shaded in light gray over here. Previously as well, during this subprime crisis, and also during the dot-com bubble burst earlier during the 2000 period. All right. So because with this rather weak so-called Conference Board leading index, that also keep the hopes alive for a potential 2 interest rate cuts by the Fed before 2025 ends. So that also support a weak US dollar as well. So you look at the CME Fed Watch 2 over here, yes, on the current we call it FOMC meeting, which is due on the 30th of July, the earliest one so far next week, market is still expecting a high chance of no cut and 95% to maintain the rate at 4.25% to 4.5%. But if you look at the aggregated tab where it showcased the expectation by Fed Funds Futures Trader across all the 12-month forward FOMC meeting next, market is still assigning a high chance now of more than 50%, which is at 62% right now. So still recall earlier previously last week, after the release of that rather hot CPI US data, the odds reduced down to around 50% now for the September meeting. So right now at the 17th of September FOMC meeting, the next meeting after 30th of July now has a higher chance of 62% that the market is assigning a potential rate cut, a higher odds to bring it down to 4% to 4.25% debt, and also a rather high chance at more than 70% at 84% that the next interest rate cut will come in the last meeting of 2025, which is 10th of December. So it has a high chance of 84% to bring it down to 3.75% to 4%. So overall, market is still maintaining a rather high odds that the Fed will still cut at least 2 times before 2025 ends. And that also keep the dollar weakness intact as well, due to a rather lackluster Conference Board economic leading index for the US, which I shared with you guys earlier. All right, so that sum up the first segment of today's daily dose. Let us now move on to the second segment, which is the intraday technical outlook on all these cross asset classes we cover on a daily basis. But before we start, let me expand my screen. All right. Okay, so let us start with the FX market first. All right, starting with the euro dollar over here. So still recall euro dollar late last week, we flipped to a intraday bullish bias because price action managed to show signs of recovery right at the medium term ascending channel when they retested last Thursday over here, and price action indeed rallied as expected and cleared above our resistance level at 117.10, 170.70, almost hit, give or take. So right now what we could see is that price action is almost coming very close to the 117.70 level, and potentially there could be a minor pullback taking shape given that the RSI has really hit the overbought level and now has really exited from the overbought. So potentially I will use the first support level to watch out for, which is the 20-day moving average as well, where price action managed to clear above it in yesterday's US session. I will use that as my first support level, 117.10 over here. I don't want to use 117.10 as my pivotal support because it's too tight given that it hasn't cleared above 170.70 yet, unless during the European session it managed to actually dip slightly and clear above 117.70, then I would actually tighten my short-term pivotal support to 170.10 for today. So in the meantime, using 170.10 as my first support, pivotal support I will tighten upwards to 116.60 for today. So as long as 160.60 for now, short-term pivotal support on the euro dollars remains whole, does not break down, we will still maintain our intraday bullish bias for the euro dollar to surge higher beyond 117.70, potentially sees the minor swing high area of 1st of July coming in at 118.25, 118.45, then thereafter followed by 119.10 next. Okay, so what's 119.10? So 119.10 is the 0.618 Fibo extension level taken from the start of this medium-term uptrend phase that is in place since 10th of July 2025 low, and graphically 119.10 is also the all the way back. If you go back over here, okay, let me share with you guys. Okay, I've got to go to the daily chart so that easier to see. Yeah, it's this medium-term swing high area of 3rd of August to 30th, okay, this level here, 30th of July 2021 and 3rd of September 2021, conferencing at 119.10. Right, so now let us go back to the current price action and let me share with you the alternate scenario if the pivotal support at 116.60 is taken up to the downside. So if suddenly there's a bearish U-turn and a breakdown below 116.60, then thereafter which means the bullish bias for the euro dollar will be invalidated to see it sliding downwards to retest the medium term ascending channel support, now acting as the next intermediate support at 116.20. So upon hitting 116.20, given that it hasn't broken below the medium term ascending channel, I'll be still on the lookout for any potential bullish reversal candlestick at that point in time to flip back to a bullish bias. But however, if there's a continued plunge below 116.20, then the bullish bias will be invalidated to see a choppy movement downwards to revisit last Thursday minor swing low area at 115.80/115.60 level. So that's for the euro dollar. And even the weaker sterling pound also started to recover as well. So the sterling pound managed to clear above our short-term pivotal resistance that we have on Monday, where previously we expect a residual down move towards 133.25. This residual bearish down move does not materialize, and we start to see the sterling dollar breaking up above this parallel descending, minor descending trend line that is in place since 1st of July high that kept the previous rebound in check. And this has really been clearly taken out yesterday and on Monday as well. And on yesterday, we start taken out on Monday, and price action yesterday continues to clear above the 50-day moving average, but it's still below the 20-day moving average for now. So first support level to watch will be at 135 figure level. Yesterday Monday's minor swing high now turns into a pullback support, so very close to the 50-day moving average. And I will use this minor V-shaped recovery that has taken shape on yesterday's late Asia session. Also, the former minor range resistance turns into a pullback support. Previously range resistance on Tuesday, 15th of July, and on Friday, 18th of July, taken out on Monday. Yesterday's during the late Asia session retested and shaped that minor V-shaped recovery. So this is indeed a critical sentimental level where the bulls managed to survive after yesterday's retest, and given its earlier bullish breakout earlier on that we seen on the European session on Monday. So in order to boost the bulls to maintain this ongoing bullish momentum, for sure 1.3470, that will be my short-term pivotal support level for today. However, if price action managed to clear above 135.45, then I will tighten the short-term pivotal support to 135 figure level thereafter. Flip to a intraday bullish bias on the sterling dollar. Next resistance level to watch will be the 20-day moving average confluencing at 135.80, followed by 136.40 next in first step, which is the minor swing high area of 7th of July and 8th of July. Only a bearish breakdown and an hourly close below 134.70 will invalidate today's intraday bullish bias to see a choppy corrective downward movement resuming again on the sterling dollar, exposing 134 figure level and 133.75 level next, which is the minor swing low of 16th of July and 17th of July. All right, so that's for the sterling dollar, flipping to a intraday bullish bias given the slew of positive element that I share with you guys, using 134.70 as my short-term pivotal support. Next up will be the Asia Pacific currency, starting with the Aussie dollar. So the Aussie dollar continues to survive after it managed to held at the 50-day moving average. So earlier on, I did mention that I'm not convinced of this bearish push down over here, given that the longer picture of the Aussie dollar still remains bullish, and this bullish bias came within our expectation. And yesterday's recovery continues to take shape as it cleared above the 20-day moving average. So hence, I'll be using a tightened short-term pivotal support zone for today, which is very close to the 20-day moving average, and this bullish breakout of that former minor swing high of last Wednesday and last Friday at 65.40/65.30. So using this 65.40/65.30 tightened short-term pivotal support zone, we will maintain our intraday bullish bias for the Aussie dollar to seek up higher highs. First resistance level to watch will be 65.75, followed by the key psychological level of 66. That price action can't break since 11th of July. A bullish breakout above 66 will more or less confirm the start of this impulsive up move bullish sequence to seek out the next intermediate resistance zone at 66.30/66.45 for the Aussie dollar. However, if price action starts to break down below 65.30, then today's intraday bullish bias will be negated to see a retest at the 50-day moving average at 65.50/ 65 figure level slash 64.85 next. So that's for the Aussie dollar, maintaining our intraday bullish bias with a tightened short-term pivotal support zone at 65.40 slash 65.30 for today. Now onward next will be the dollar yen. So before I jump into intraday outlook on the dollar yen, still recall that on Monday we have a bearish bias. Why? Because the dollar yen really hit the upper limit of this rather complex ascending sideways range configuration that is still in place since 12th of May over here. So the pivotal resistance at 149 figure slash 149.60, we're so very close to the 200-day moving average. Indeed, it hit the top of this medium-term ascending sideways range, and price action starts to drift downwards in the last 3 days over here. All right, so that actually arose our suspicion that right now it may continue its drift downwards towards the lower limit of this ascending this medium term complex ascending sideways range configuration. There's still no clear trend yet for the bulls or the bears. It's just that we are now playing a reaction of the key medium term resistance level, and once this key medium term resistance that once this price action has hit down the lower limit of this medium term ascending range configuration, which is 144 which is around this 144.40 level, then from there we could actually flip back to a bullish bias again. All right, so just bear in mind that it's still trading within this rather complex medium term sideways range ascending sideways range configuration. Just that right now we are more confident to flip back to a bearish bias because it really hit the upper limit of this sideways range configuration that confluence with a key 200-day moving average at the 149 figure level slash 149.60. So onward next with our intraday technical outlook. Still recall that on Monday we do have a bearish bias. All right, so price action really hit the support level and pierced below it at 146.95, and now approaching the 20-day moving average at 145.85 before bouncing upwards. And you recall that this bounce didn't manage to actually clear above 146.95 over here. Okay, 146.95. This earlier spike up was that dovish comment from Deputy BOJ Governor, but overall the dollar weakness still cannot be surpassed at this moment in time based on the technical analysis perspective. And also, if we look at the current situation on the RSI, yes, the RSI managed to exit from the oversold, but while exiting from the oversold, there is no bullish divergence as price action on the RSI continues to shape a lower low in line with the lower low that's being seen on the price action of the 1 hour chart of the dollar yen. And also the dollar yen, also the RSI managed to get rejected from this parallel descending trend line as well that is forming right below the 50 level mark, so indicating that bearish momentum in the very short term still remains intact on the dollar yen. So no change given that price action hasn't broken below the 20-day moving average, which is so the 145.85 level. So I do not want to tighten my short-term pivotal resistance to this bearish reaction, this intermediate resistance bearish reaction over here at 146.95, unless during the European session we could see a price plummet lower towards 145.85, then I would tighten it to 146.95. So for now, the adjusted pivotal resistance will be the bearish reaction that is being seen during the start of the European session yesterday that kickstart this intraday bearish weakness throughout the entire US session. All right, that taken shape from the high of 147.90 all the way down to the intraday US session intraday low of 146.27. So using a tighten pivotal resistance for now at 147.90, maintain that intraday bearish bias. 145.85 will be the first support level to watch. Breakdown below it exposes 145.20, then followed by the lower limit of this medium-term ascending range support from the low of 22nd of April 2025 low, coming in at 43.90. So only tighten the short-term pivotal resistance, pardon me, not support, tighten the short-term pivotal resistance to 146.95 unless we have a bearish breakdown during the European session at 145.85. So for now, the pivotal resistance will still be a tighten one. Previously on Monday, we were at 149, so I'll shift it downwards to 147.90. Currently, that's the short-term pivotal resistance level to watch. So however, if price action starts to pierce up above here, above 147.90, then today's intraday bearish bias view will be invalidated to see a retest at the medium-term pivotal resistance zone, which is 149.90 slash 149.60. All right, so that's for the dollar yen. That's also sum up the intraday technical outlook on this 4 major US dollar pairs. So now let's start with the 6 major stock indices, starting with Hong Kong, which represent the Hong Kong 33. So what we could see right now over here is that price action already hit our resistance level after piercing above the former medium term swing high area of 18/19 of March this year. So what we could see right now is that price hasn't broken above 25,400/25,480 yet. So there could be still some form of minor pullback taking shape, but overall the bullish trend still remains intact. First support level to watch will be 25,105 over here. Unless we have an hourly close above 25,480, that I will tighten my short-term pivotal support to 25,105. For now, my adjusted short-term pivotal support will be at 24,850 level, which was the former medium-term swing high of 19th of March, now turns to a key pullback support level. Maintain our intraday bullish bias for the Hong Kong 33. After 25,480 will be 25,650/25,750 level, which is the 0.618 Fibo extension level taken from the low of this level of 9th of April, and also at the upper boundary of this ongoing major ascending channel from the low of January 2024. Only a sudden bearish U-turn and a break below 24,850, a bearish hourly close below 24,850, that would invalidate the Hong Kong 33 intraday bullish bias stance and see a minor corrective pullback unfolding again, drifting downwards towards 24,630, followed by 23,390, which confluence with the rising 20-day moving average. So for now, still maintain our intraday bullish bias on the Hong Kong 33. Using a tightened short-term pivotal support at 24,850. Unless we have an hourly close above 25,480, then I will tighten my short-term pivotal support to 25,100 next. Okay, so that's for the Hong Kong 33. Upward next will be the Germany 30. The Germany 30 has been underperformed. Sorry, not the Germany 30, but the Nikkei 225. All right, so I almost forgot, pardon me. So the Nikkei 225, still recall that previously we will have a bullish bias because of the bullish element that we highlighted earlier on last Tuesday. Price actually indeed react off it and did that very strong bullish reversal push up, reinforced by that trade deal that is being done between US and Japan. And right now, the resistance level has really been made at 40,850/41,050 over here. So I do not want to be outright bearish right now, given that the momentum is still very strong, but I'll rather be bullish on dips instead. So given that the hourly RSI, there's no form of bearish divergence. Yes, it's extremely overbought right now, right, almost hitting the previous peak that was seen on 27 of June over here. So there could be some form of a minor pullback taking shape, given that the first resistance zone has been made. First pullback support level to watch will be at 40,446 over here, right? 40,446 over here, which is also the minor congestion area at this point in time. Okay, in fact, it's a zone. Okay, let me highlight. This should be a zone over here. Okay, this is the congestion zone. Okay, at 40,610, 40,450. And if you will do the Fibo retracement of this steep up move that has taken shape from yesterday all the way down up to today's intraday high, that also constitute the 38.2% Fibo retracement, all right, over here. So this will be the area that I will be very interested to be bullish on dips over here, with the pivotal support level at this minor range top now turns into a pullback clear pullback with support level, previously rejected on 4th of July, rejected on 18th of July, rejected on early Tuesday Asia session that is spike up before it thundered downwards. So this will be indeed a key sentiment support level to watch to maintain the bullish bias. So as long as this tightened short-term pivotal support is reintegrate downwards, price indeed reintegrate below 40,110, we will have a bullish bias on a minor after a minor potential pullback that could take shape on the Japan 225. Next resistance level to watch will be 41,620, followed by 41,940/970, and above it will revisit the all-time high area that was being printed in last year July at 42,513 next. 42,513 next. Only a bearish price action breakdown below 40,110 that would invalidate the bullish bias move on the Japan 225 to see a rather complex sideways, rather see a kind of a choppy corrective decline sequence unfolding again, revisiting 39,720, followed by 39,400, which is this congestion area over here, and also the pullback of this former bullish flag formation, bullish flag resistance now turns into a pullback support level at 39,400. All right, and 39,720 also confluence with the 20-day moving average. So that's for the Japan 225, still maintaining our intraday bullish bias, but there could be a risk of a minor pullback taking shape given the steep up move that has already taken place. Pullback support level to watch 40,610, followed by 40,450. Then the pivotal support level will be at 40,110. That's for the Japan 225. All right, next up will be the Germany 30. So the Germany 30 also managed to recover after a test at the 50-day moving average yesterday, and also now it also pierced above the 20-day moving average as well. I think as a first support at 24,040 level. So given that it hasn't cleared above the resistance at 24,310, which was the rejection level on Monday, that causes this steep intraday sell-off, and this steep intraday sell-off managed to pause at the 50-day moving average, so giving some signs of bullish bias that is still intact for the Germany 30. So for sure, the key support level managed to survive again previously on 16th of July, and also managed to survive on Tuesday as well. So using 23,930 and so confluencing with a key element, the 50-day moving average. So this will be my short-term pivotal support for today, 23,930 short-term pivotal support, maintaining the intraday bullish bias on the Germany 30. Intermediate resistance level to watch, or the upside trigger level, will be at 24,310 level. A breakout above 24,310 exposes 24,520 next. However, if price action starts to break down below 23,930, today's intraday bullish bias will be invalidated to see a corrective decline sequence unfolding, retesting the minor swing low of 1st of July and 2nd of July, I think as a next intermediate support at 23,640. Next up will be the major US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average yesterday traded sideways before managed to bounce up, okay, at the start of the US session, right at the rising 20-day moving average, which is indicating signs of bullish bias still remains intact. The hourly RSI continues to trade higher over here, okay, above the 50 level mark. So yesterday price action during the close of the US session managed to hesitate at the 44,620 level. All right, so this is a minor descending trend line that is still in place since the 7th of July high over here. So there could be a bit of minor pullback taking shape given a bit of hesitation over here. So first support level to watch for sure will be this level here, which is very close to the 20-day moving average at 44,440. Still using the pivotal support to remains the same at 44,150, because I don't know, tighten it so tight over here just in case of the whipsaw. Still maintaining our intraday bullish bias for the US Wall Street 30. Above 44,620 exposes 44,850, followed by the current all-time high that was previously printed in December last year at 45,100. Above it sees a next resistance level, which is defined by Fibo extension cluster level at 45,455/45,520. Only a bearish breakdown below 44,150, then that will see a choppy corrective decline sequence, revisiting 43,800/43,600 next. So that's for the US Wall Street 30. Up next will be the S&P 500 index. So S&P 500 managed to actually shape a bounce right exactly at the first intermediate support that highlighted on Monday, and retested the first resistance at 6,330/6,355. So given that it has have a clear breakout above 6,355, I do not want to tighten my short-term pivotal support to 6,290. So still remains at 6,255 unless during the start of the European session we have an hourly close above 6,355. Then I could tighten it to 6,290, which is the bullish reaction of it yesterday. So still maintaining our intraday bullish bias on the SPX 500. Next resistance level to watch will be 6,370, followed by 6,380. Above it says 6,430/6,450, which is a 0.618 Fibo extension. 0.618 Fibo extension taken from the low of 19th of June, and another Fibo extension taken from the low of 24th of May, and also this medium-term ascending channel that is in place since the low of 23rd of May. All right. So, however, if price action starts to break down below the pivotal support level at 2062.55, pardon me, then we will see another round of corrective pullback scenario unfolding again, revisiting 6,220 followed by 6,180, which is close to the lower limit of this medium-term ascending channel. So, i.e., overall, still maintaining our bullish bias on the S&P 500. Two key support levels to look out for today to maintain this bullish bias: 6,290, and the very key one will be 6,255. Up next will be the Nasdaq 100. So the Nasdaq 100 also hit our first resistance level at 23,190 yesterday before drifting downward, managed to survive the first support level at 23,020. And also that is so slightly above the pivotal support at 22,920. So still no change, still maintain that bullish bias on the Nasdaq 100 as it continues to trade above the rising 20-day moving average, and also within this medium-term ascending channel that is in place since the low of 23rd of May. So given this bullish element that we are seeing right now, and so the RSI also managed to bounce out from the oversold level. So unless we have a hourly close above 23,190, then I would tighten my short-term pivotal support to 23,020. So for now, still using the same pivotal support at 22,920 on the Nasdaq 100, maintain our intraday bullish bias. Next resistance level to watch after 23,120 will be 23,400 / 23,480, which also confluence with the upper limit of the medium-term ascending channel that I shared with you guys earlier. Only a bearish breakdown in the hourly close below 22,920 will invalidate today's outright bullish bias move to switch the focus back to a potential minor corrective decline sequence unfolding, revisiting 22,650 next. A breakdown below 22,650 may see 22,390 next, which is very close to the medium-term ascending channel support level. Okay, actually, it's a zone. Okay, it's a zone over here. All right. Should be 22,480. Okay, 22,480 / 22,390. So overall, maintain our key bullish bias for the Nasdaq 100 for today with two key support level to watch: 23,020 followed by 22,920. All right, so that sum up the intraday technical outlook on all these 6 major US stock indices. Let us now focus our attention to the commodity asset classes, starting with gold XAU/USD. So gold XAU/USD managed to surge up as expected, and now hitting our second resistance level at 3,450, which is the minor swing high area of 16th of June, okay, before this complex corrective pullback take shape over here. And what's interesting over here is that the RSI now has shaped a bearish divergence. All right, there's a lower high on the RSI at the overbought level, but a higher high that's being printed out on the raw price action of gold XAU/USD. So right now, there could be a potential chance of a minor pullback taking shape to revisit this pullback area of 3,400, followed by 3,385. 3,360, and if you do the Fibo retracement of this last recent tremendous spike up from the low of 17th of July all the way down to today's Asia session intraday high, that also comprises the 38.2% Fibo retracement and the 50% Fibo retracement as well at 3,385 / 3,360. So with that a lack of bullish momentum with this bearish divergence that is seen, there could be a chance of a minor pullback taking shape for today, at least for today, before the honors flip back to the bulls again. So I will be having a bearish bias, but not looking out for a very medium-term bearish reversal move. But from the medium-term perspective, the honors has now flipped to the bullish side. It's only for an intraday view for today that I will flip back to a bearish. I'll flip to a bearish bias for this minor corrective pullback to take shape, using 3,450 as my short-term pivotal resistance level. Key support level to watch for today, or minor key support level to watch for today: 3,400 / 3,385 / 3,360. So once price action drift down very closely to 3,385, I'll be flipping back to a bullish bias again, looking out for signs of opportunity like a bullish reversal candlestick, given that the medium-term uptrend is still bullish for gold XAU/USD. However, if price action didn't move down as intended towards 3,400, and from here it immediately pierces upwards, then I got to respect the very strong bullish bias impulsive movement above 3,450 will see the continuation of this impulsive up move for today, targeting 3,480 next, followed by the current all-time high that is printed in 22nd of April this year at 3,500. So that's for gold XAU/USD. Next up, West Texas crude oil. So the West Texas oil continues to plummet downwards, now testing the lower limit of the sideways range configuration that is in place since 25th of June. And given that the price action is now rather weak below the 20-day moving average, and what we could see is the hourly RSI also being kept by this descending trend line over here, and is now inching backwards towards the 50 level mark. All right, indicating the lack of upside momentum. And given the lack of upside momentum, there could be an immediate bearish breakdown of this range support level at 6610/6520. So with that, I will have a tightened short-term pivotal resistance for today at 6740, which is so confluence with the 20-day moving average as well. So using a tightened short-term pivotal support resistance at 6740 for West Texas oil, will maintain a intraday bearish bias in anticipation of this range bearish breakdown. A breakdown below 6520 exposes the next support level at 6275 in the first step, which is the minor swing low area of 3rd of June and 5th of June. Only a bullish breakout above, a bullish push up above 6740 will revisit this range top resistance again, which is also confluence with the 200-day moving average at 6850/6915 next. So flipping to a intraday, maintaining the intraday bearish bias in anticipation for a bearish range breakdown for West Texas oil, using 6740 as my short-term pivotal resistance level. All right, so that sum up the intraday technical outlook on all the broad-based cross asset classes. Now let us turn our attention now towards the economic calendar. What are the key data to look out for today, and as well as any key events to be paying attention to. So today will be Wednesday. So Wednesday over here at the start of the European session, there is no key data to look at, except when the US session kickstart at 10 p.m. Singapore time. You have consumer confidence flash data for July in Eurozone that will potentially impact the euro dollar, the euro crosses, and the Germany 30 CFD index. And at 10:30 p.m. We have the weekly EIA energy crude oil stockpile change. So that could influence the intraday movement of the West Texas crude oil over here. And stretching into the early Asia session will be rather quiet, but something to take note of is today will be the release of the two mega cap stocks, one technology, one non-technology in the US stock market. So what are they? It will be Tesla and as well as Google, Alphabet over here. So today will be Wednesday. So can go all the way down. Yeah, so Alphabet and Tesla will release their Q2 earnings after the close of today's US session, which is at early Thursday after 4 a.m. Singapore time. So something to look out for, and that could potentially influence the movement before, even during today's US session, and as well as after the close of today's US session upon the release of Alphabet, which is Google, and Tesla Q2 earnings after 4 a.m. Singapore time on early Thursday. All right, and also before the start of our daily dose at 7 a.m. Singapore time, you have the release of Australia preliminary manufacturing PMI and services PMI data, and that could impact the Aussie dollar, the Aussie crosses, and the ASX 200 CFD index. All right, so with that, that sum up today's daily dose of market insights. I'm Kelvin here, signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.